Okay, so I was skimming the internet the other day and I came across this really unsettling article by Lou Barnes where he argues that the entire financial media is ignoring a signal that could show the entire housing market is in trouble based on there being no buyers for mortgage-backed securities, or MBSs. Lou has been a mortgage broker for 44 years and maintains a decently popular blog online. And in a recent article, he says that this is one of the top 5 most painful moments he's seen, even going so far as to compare it to the 2008 housing collapse that started the Great Recession. Now, I'm not one to take every theory that I read online seriously, but what stood out to me here is Lou's experience in this very specific area of mortgages and how the seemingly innocuous signal of mortgage-backed security bids can translate into everything from housing to stocks crashing like the world's biggest set of dominoes. And it all starts with this graph of mortgage rates on housing shooting up like a rocket in recent months. Mortgage rates are simply a measure of what interest rate a bank will charge you to take a loan on a house. This is important because housing is the single largest purchase that most people will have in their entire lives. And it is rare for someone to be able to afford to buy a house without taking out a loan. In fact, the data shows that only around 30% of home sales are done in cash, and that is likely overrepresented by large investors rather than individuals. This also means mortgages and mortgage rates exert a large influence on the housing market. So mortgage-backed securities affect mortgages, which affect the housing market, which in turn affects nearly every aspect of our lives, which is why it's so important to understand what Lou is saying here. So hey everyone, and welcome to FinTech. And in this video, I'm going to break down what exactly has an expert like Lou worried so much about the housing market, and talk about what this could mean if the crash expands outside of housing and hits everything from stocks to GDP to jobs like the 2008 crash did. And I also want to say that this is just a theory and I don't necessarily agree with it, but I thought it was interesting enough to give it some attention. So first off, we need to go over what a mortgage-backed security, or MBS, actually is, because unless you work on Wall Street or maybe you've watched The Big Short recently, you probably don't know or don't remember what that is. A mortgage-backed security is just a fancy way of selling mortgages. So for example, if you take out a loan on your house, you agree to pay that mortgage back to Bank One over time, usually over around 30 years. But Bank One doesn't have to keep your loan all 30 years. They can sell that loan to another bank if they want to, and then you just pay your interest to bank number 2 now instead. Now, a mortgage-backed security is typically when a big bank takes a whole bunch of these smaller loans and puts them together into one big bundle so that they can just sell that in one big chunk to another bank. So in your mind, you can think mortgage-backed security, or MBS, just equals a bundle of loans. Okay, that's the boring stuff out of the way. Now let's get to the good part. Now there's an open market for buying and selling these bundled loans that big banks participate in. Bank number 1 can put their MBS on the market, and bank number 2 can buy it if they like the price. If not, they can offer less for the MBS at whatever price makes sense to them. But for the first time since 2008, banks were putting mortgage-backed securities on the market and no one was bidding for any of them. Basically, the entire market broke down, and while we haven't felt the full effects of that yet, they're coming soon. As Lou said in his article, MBS are such a weird market that other markets have not yet processed what is happening. Stocks are down 2% today, but would be down a hell of a lot more considering what a full stop to housing will mean. But when will we see that impact hit, and why are we all of a sudden seeing a no-bid day in the MBS market? Well, to understand that, we need to go back in time for a minute. Lou mentioned that in his 44 years in the mortgage market, he's seen 4 painful moments that stand out before this most recent one. And understanding what made those moments so painful and what their effect was in the long term can help us understand what's happening today and what the ramifications could be in the long term. The first moment was in 1979, Columbus Day weekend on a Saturday. In the previous 15 years, the US had experienced some of the worst inflation on record, with the combination of high inflation and low economic and job growth labeled stagflation. This is also something that many economists today are worried about, as the Fed raises interest rates amid a potentially cooling economy. In response to the 1970 stagflation, the Federal Reserve decided enough was enough, and they allowed the price of money to float as high as it wanted in an attempt to break out of this stagnant period. Well, mortgage rates immediately shot up, going from 11% that Friday, which is already ridiculously high by today's standards, to 13% by that first working day on Tuesday. And the rise in prices did result in a temporary dip in housing prices, but it did not result in a full-scale housing collapse or a market crash. Now, this is sort of a best-case outcome for what we would hope to replicate today, but things may not be that easy this time. The second painful moment Lou describes took place in 1994, 1 year after the recession of 1993. Inflation rose that year from 1% at the start to 5.25% by the end of the year. And in 4 months, from February through May, mortgage rates rose 2%, from 7% at the start to 9% by the end. Now that 2% is again the sweet spot that pushed housing over the edge and completely flattened the housing market. Lou explains that historically, any 2% rise in interest rates completely freezes interest in housing. And that's why these past two events were such big deals. Now, the 1994 case again ended up all right, with the Fed cutting rates and successfully avoiding a double-dip recession. But then we get to the last two painful moments, which both connect to the only true housing market crash that we've ever seen in the US, the 2008 financial crisis. The first warning signs showed up in 2007, when both subprime and mortgage loans went no bid on the market. Jumbo loans are just loans on houses that are too expensive to qualify for a traditional loan, which means that they're riskier for banks. Subprime mortgages are simply mortgages that are more risky and have a higher chance of defaulting than traditional mortgages. And if you're at all familiar with what was happening in the years leading up to 2007, you'll understand why the market suddenly froze. The housing bubble of the early 2000s was caused by an unholy union between Wall Street banks, insurance companies, and credit rating agencies. Wall Street started buying up mortgage-backed securities like they were candy because they could sell them off to investors and turn huge profits very quickly. Insurance companies then insured those investments because they figured housing never crashes, so they must be safe. On top of that, credit rating agencies like Standard & Poor's went ahead and rated basically every mortgage-backed security as if it was a risk-free AA or AA+ investment. And the result? Money just poured into the mortgage market. Now the problem was, this easy money incentivized shady brokers to start offering mortgages to pretty much anyone with a pulse. You didn't need money to pay it back because the brokers would only be holding it for a few days before selling it on Wall Street to some investor who assumed it was a good investment since, the credit rating agencies and the insurance companies said that it was safe. But when the housing market started to dip, the first warning sign was that no one was willing to bid on the riskier mortgages like jumbos and subprime mortgages. Then, 1 year later in July 2008, the whole market collapsed. Lou's last and most serious painful moment came in 2008 when the entire mortgage market went no bid, similar to what's happening today. And as Lou says in his article, the 10-year T-note anticipating recession and worse fell to 3.5%, while retail mortgages rose to 7%. That 350 basis point spread is the closest comparable to today's 300 basis points. And I don't know about you, but I would prefer if our economy didn't have too much in common with just the greatest economic collapse that we've ever seen. But what can these previous pain points tell us about the mortgage market, and what does the current market going no bid mean for the economy as a whole? Well, Lou describes the market almost like a pool table, where the first collision sets the ball rolling, but it's not until the second collision that the impact is felt. The first collision in today's market came from the rapid mortgage interest rate rise over the past 6 months. In January, mortgages were around 3%. By February, they hit 4%. At the end of March, 5%. But by May, we were seeing 5.5% interest rates on new mortgages. So we are currently sitting at twice the mortgage interest rate that we saw in January and up nearly 3% this year alone. And remember, historically, all it takes is a 2% rise in mortgage rates to freeze the housing market, according to Lou. And in the pause since then, almost like the calm before the storm, mortgage rates have held steady. But it was just like we were Wile E. Coyote running off a cliff, but suspended in the air for a moment. Then the second collision came. Similar to what we saw in 2008, there was a long pause between when the event happened, in this case mortgage rates rising, and when we started to see the effects. Lou speculates this delay is because people who were desperate to buy a home before the rate hikes are still desperate to buy those homes afterward. Maybe they're even happy that the competition is starting to dry up. But you know that eventually we have to face the music, just like Wile E. Coyote falling off a cliff. But what about the next impact? While the MBS market completely froze, stocks have not reacted as dramatically as you might expect, only down around 2% the day the no-bid market happened. But considering how much a full stop to housing could mean for the economy, Lou thinks stocks should be reacting a lot more. And here's why. Housing makes up the second largest percentage of the average American's net worth after retirement accounts, at 28.9% of their net worth, according to the US Census Bureau. And that study was conducted back in 2017, so with housing prices rising, I wouldn't be surprised if the current percentage of wealth tied up in housing is substantially higher today than it was then. And if the market for mortgages dries up, that has a domino effect throughout the entire housing market, dropping the value of real estate overall. And that massive pool of wealth and housing housing that's been inflated recently by stimulus checks and money printing by the Fed suddenly dropping in value would absolutely have repercussions around the economy, taking down stocks and other assets with it. Which is partly why, the last time we had housing crash, we had a Great Recession. Now, Lou's article has this very somber note, and he doesn't seem to have a lot of hope for the US government pulling us out of this. But we probably won't see much help from other areas either, seeing as Europe may already be in a recession, and China has been taking a very aggressive stance to pop their own housing bubble, which may have led them into a recession too. So is it totally hopeless? Are we doomed to a recession? Well, one thing we do know for sure is that at some point in the future, we will see another recession. Historically, we've seen one roughly every 6 years, so we are well overdue. Now, I actually remember the 2008 recession pretty well, and even though I wasn't working at the time, I can remember how it impacted my daily life. I had a lot of friends who ended up moving out of the state because their parents needed to find work, and pretty much no one was spending money on luxuries like going out to eat or doing anything fun. There was a couple-year period where we didn't even go out to McDonald's. But it's good to remember that not every recession is going to be as bad as the one that we just saw. So far, the market crash has not been nearly as rapid or dramatic as the one in 2007, although granted there is still time. And even though articles try to farm clicks by using scary words like recession or crash, like this video, the reason I'm doing it is to maybe catch people who feel like they don't know what to do and they're scared. And there's no reason to be scared. The number one thing that you can do to protect yourself in a recession is to avoid making hasty panic decisions, like selling all your stocks or taking on 50% margin debt trying to buy the dip. If we look at historical data over the past 100 plus years, the best strategy is simply to continue to dollar cost average into the market over time, putting the same amount of money into a broad market index fund like VTSAX every month and forgetting that it's even there. If you do that and you pay off high interest debt that could put you in danger of defaulting during a downturn, you will be better off than 99% of people who try to time the market or who just panic and sell. That is my genuine belief, and that is what I am doing with my retirement accounts. Don't forget to like and subscribe, and I'll see you next time.